Chapter 17, we talk about the stock market and buying and selling within that stock market. So basically, stock or equity is ownership interests in a corporation. So, they have shares of stock outstanding. Everyone who owns a share owns a little piece of that company. So that is what they consider equity, or what they consider that residual claim on their assets. That's what makes it risky, is that if you are a stockholder and that company were to start to go under, you would be the last person to get your money, because again, you're part owner, so you're taking all those risks with your investment. Or thinking about, even if they're profitable and they have income, sometimes you're the last person to see that income, because they're going to pay their bond interest that's required. They're going to pay their taxes. They're going to maybe keep some of that income to finance projects. So again, the stockholders are going to be kind of the last people to receive that income. They have, when the corporations are going to issue, there's ways that they can raise capital. They can either issue common stock, they could issue preferred stock, or they could issue bonds, or they could get bank loans. So those are the ways that corporations raise capital. Then it talks about that if they could also have times where they're buying back their shares of stock. So that's called a share buyback. And what I find when companies are doing that, normally it's because they either want to shift kind of how they're financing their projects. So say they've been a little bit more conservative, and they've been issuing shares of common stock instead of debt. Now they feel a little more secure. They've got income coming in, and they're going to shift that. Then they're going to increase their debt, take that money to buy back shares of stock, so it reduces their equity. It gives a higher return to the shareholders that do stay around, because what they're doing is they're retiring, or they're buying, putting into their treasury shares that were previously sold to investors. Then again, like I mentioned, there's two different types. There's common stock and preferred stock. So common stock, you are again part owner of that company. So you have a claim on their assets, and you would get dividends if the board of directors chooses to pay dividends. Where the preferred stock, those are going to have a higher quality. They're going to have a higher claim on the assets. So again, if the company were going under, the preferred stockholders, will get their money first, and then the common stockholders would get their money after. Same with dividends. If the board of directors do decide to pay dividends, the preferred stockholders will get their dividends first. If they're cumulative dividends, they'll get any dividends that are in arrears, anything that they did not pay, they'll get those first before the stockholders will get them, the common stockholders will get them. And then there's two different markets. There's a primary and a secondary market. So the primary market is when the investor buys directly from the corporation. And I feel like that's not as common anymore, but I mean, obviously it does still happen. But that would be the primary market. The secondary market is when those shares are already issued and outstanding, and one investor's just selling to another investor. And in the secondary market, those sales happen over the NASDAQ, or over the counter, the OTC, over the counter over NASDAQ. And then different corporations are listed in the New York Stock Exchange or in the NASDAQ. So you can kind of read over that section in the textbook. So then pricing, there's different ways to price it. And the textbook gives you a lot of formulas. I think the one that is probably the most relevant one that investors use is the price to earnings ratio, where you're looking at the current market price of the stock, comparing that to the earnings per share to determine is it a good investment, is it overvalued. There's also a price to book ratio, where they look at the market price to the book value, which would be more like historical, about what people have paid in the past compared to what the current market price is, again, to determine if it's a good investment. And then our overall performance of our stock market, there's definitely business cycles, and there's different things that impact the market. So there's times where the economy is booming and pretty much all stock is going up. And then there's times where the economy is in a recession, or like currently what's going on with the coronavirus, and it's kind of a worldwide panic, then pretty much everybody's going down. There will be some kind of like, major companies that are going to stay strong. So I kind of feel like Walmart and Amazon and Procter and Gamble and some of those companies are going to stay strong, but most companies are going to kind of take the dive with the market. And interest rates can also impact the stock market. As interest rates go up, I mean, people could find the bond market to be more lucrative. As interest rates go down, I mean, people may be encouraged to spend their money. And then even businesses may want to try to go with bank loans and kind of go into more of a bank financing agreement, because that would be cheaper for them. So sometimes those things can kind of impact the stock market as well. And we do have a large global market. We have to understand that there's buyers and sellers across the world that impact the price of our stock. Then it talks about the different indexes. So you've got the Dow Jones Industrial Average, you've got the S&P 500, and you question if some of those are useful. And so, because I do feel like it's a select few of companies that are in those, but they feel like they cover companies kind of across the different industries, and that they still represent the market, or they can represent the market as a whole. So I mean, I guess they are still relevant, and it's definitely a site that's sourced on a regular basis. The regulation of our stock markets is set by the Securities and Exchange Commission, or the SEC, and they govern all companies that are issuing shares of stock. And the SEC requires that all companies go through a formal audit at the end of each year, and that they are providing those audited financial statements to their investors. So at least we feel like that there's definitely a big brother that's watching those corporations and kind of, but so the Securities and Exchange Commission is designed and developed, though, to protect us as investors. Then it talks about, is the market efficient or not? And the efficient is that, do the market prices always reflect all relevant information? So that would be a question, is that really happening? And are our stock markets truly efficient? So the efficient market hypothesis is the idea that it is impossible for any one investor to earn a return above the average market return, because the market is efficient in that process, in that the market prices reflect all the relevant information. So I think we kind of know to some extent that's not completely true. There are investors who do seem to do better, and then obviously there's some that seem to do worse. Maybe if you were looking at like our law of large numbers, the majority of us probably fall into this category. We also know, of course, that there's always stories of insider trading, people who know stuff that's going on and can capitalize on those investments. People have also been jailed for those things if they're caught, but that all ties back to information, and that's kind of what this hypothesis is referring to, is the is if we have all the information about that corporation or that investment, kind of what happens. Then it talks about a weak form, where it assumes that the stock market prices reflect all market-related information, including the historical price and volume. And if it's a weak form of efficiency, investors cannot earn an abnormally high profit using those historical prices. A semi-strong form of efficiency assumes that stock prices reflect all public information, including announcements made by the firm, economic news and development, as well as political news and developments. So that's going to be more information that we have. And then in that type of efficiency, the investors cannot make an abnormal profit by trading on public news releases, because the information will be reflected in the prices. So again, everybody knows. So there's not one person who has that inside knowledge. The strong form of efficiency assumes that stock market prices reflect all information, including private and inside information. If that strong firm holds, then there's no set of information that allows investors to make an abnormal profit. So again, everybody knows everything, but I think we know in real life that that's not always the case, and that sometimes there are people who have that inside information and can profit from that. And then that doesn't, the rest of us can't quite compete with that. Okay, then the last topic is behavioral finance, and it talks a little bit about just different people, different investors, and kind of what can happen in the market. So they talk about that there can be overconfidence in the market, which can lead to stock markets assuming that these future forecasts are going to be more accurate than they are, and then stock prices are going up and everybody's buying. There can be confirmation bias, where stock market participants place more weight on information that agrees with their pre-existing opinion, which tends to probably be most people in general. If something confirms what you already believe, you believe it all the more. Framing matters. How a question is framed might affect an answer a person gives, or how he or she reacts, so that kind of maybe how the information is released to us impacts how we're going to invest in that. And then there's noise trader risk. Noisy traders keep pushing the market price away from a rational price. And then there can be implementation costs, where there's transactions to buy and sell those shares that can lead to more of a potential gain for investors, or for the finance people. Actually, the traders would be the people who would gain if there was those implementation costs. And sometimes you do have to take advice from a broker carefully. Just do your own personal research, because sometimes they do get different fees or different costs that come into them as income, and they can push for investments that may or may not really be to your advantage. So that is kind of the overall view of our stock market, which again is a huge financial market, and we hear a lot about it in the news, both in good times and in bad times.